Welcome to our deep dive on diversification and concentrated sector bets. First, we will frame the common dilemma many long-term investors face: sticking with a broad global ETF versus moving heavily into domestic bank stocks for perceived safety and dividends. Then, we will unpack the risks, explore how diversification works, and show practical steps you can take. Finally, we will test your understanding with quizzes and summarize the key takeaways. Next, here's our roadmap. We will start with the core misconception, then explain diversification mechanics, followed by the risks of concentrating in bank stocks. After that, we will walk through decision flow diagrams, compare approaches, and share an actionable plan. We will also include quizzes to reinforce your learning and conclude with key takeaways. Before we proceed, a quick disclaimer. This content is educational and does not constitute investment, tax, or legal advice. Please conduct your own research and consider consulting a qualified professional who understands your personal circumstances. Now let's define the debate. Many long-term investors gravitate toward large domestic bank stocks because they pay attractive dividends and appear stable. However, we must question whether this is truly safer over decades versus holding a diversified global ETF that spreads risk across sectors, geographies, and currencies. First, the core misconception that a handful of national bank stocks will reliably outgrow the total stock market over long horizons. This belief is flawed because it ignores sector concentration risk and the power of diversification. In reality, global all-in-one ETFs hold hundreds or even thousands of companies, spreading exposure across industries, countries, and currencies. While dividends are attractive, concentrating in one sector magnifies unsystematic risk, which is the company and sector-specific risk that diversification can significantly reduce. Next, let's explain diversification. A global ETF spreads your exposure across sectors like technology, healthcare, industrials, and financials, as well as across regions and currencies. The result is many smaller, often less correlated bets. This structure does not eliminate market risk, but it reduces idiosyncratic or unsystematic risk from any single company or sector. Over time, this broad exposure tends to deliver more stable compounded outcomes than a concentrated bet. Now consider the risks of concentrating in bank stocks. Regulatory changes can rapidly alter profitability across the sector. During credit downturns, banks can suffer correlated defaults, leading to simultaneous earnings pressure. Dividends that once seemed reliable may be cut, particularly in severe stress environments. Furthermore, home country bias leaves you more exposed to local economic and currency shocks. In effect, your entire future becomes dependent on the performance and regulatory environment of a single sector. Let's visualize crisis propagation. Starting with an economic shock, bank balance sheets deteriorate as credit losses rise. This leads to earnings compression, which often triggers dividend cuts. Consequently, share prices fall, and a portfolio concentrated in banks experiences a steep drawdown. In parallel, a diversified ETF holding technology, healthcare, consumer staples, utilities, and more spreads the impact across less correlated sectors, diluting the damage. Therefore, the same shock that devastates a concentrated banking portfolio may be partly absorbed within a diversified structure. Meanwhile, this decision flow clarifies the trade-off. Choosing a global ETF points you toward multi-sector, multi-country, and multi-currency exposure. This reduces unsystematic risk and generally produces more stable long-run outcomes. Alternatively, choosing 5 banks concentrates exposure in a single sector with heightened regulatory sensitivity, leading to a higher chance of severe drawdowns during sector-specific crises. Now, let's compare directly. A global ETF typically holds hundreds or thousands of companies across many sectors and countries, lowering unsystematic risk and sourcing dividends broadly. Although market volatility remains, idiosyncratic shocks are diluted. Conversely, concentrating in 5 bank stocks exposes you to a single sector with domestic policy risk and correlated credit events. Dividends that seem stable may be reduced or suspended in downturns, and drawdowns can be catastrophic when the sector faces severe stress. Consider this matrix. Unsystematic risk is low in a global ETF because exposure is spread widely, whereas it is high in a 5-bank portfolio. Systematic market risk exists in both cases. Dividend reliability is sourced broadly in a global ETF, but depends on one sector in a bank-only portfolio. Regulatory and policy risk is diversified across jurisdictions in a global ETF, but concentrated domestically in banks. Currency risk is multi-currency in the ETF, and home currency heavy in banks. Finally, in a sector crisis, the global ETF often faces moderate to severe drawdowns, while a concentrated bank portfolio can face severe to potentially total losses. To put this into practice, start by writing an investment policy statement that clarifies your goals, time horizon, and risk tolerance. Next, select a low-cost, all-in-one global equity ETF, and set a target asset mix that fits your profile. Then, automate contributions to stay disciplined, and rebalance on a schedule or using tolerance bands. If you choose sector tilts, keep them as small satellite positions rather than core holdings. Focus on total return rather than chasing yield, and remember dividends can be cut. Keep an emergency fund separate from investments. Consider tax efficiency, and monitor your portfolio without overreacting to short-term news. Quiz time. Which type of risk is most reduced by holding a global all-in-one ETF compared with 5 bank stocks? Your options are unsystematic company or sector-specific risk, systematic market risk, inflation risk, and longevity risk. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is unsystematic company or sector-specific risk. Diversification across many companies, sectors, and regions significantly reduces idiosyncratic shocks. Market risk, however, remains present in any equity portfolio. Second quiz. If domestic banking regulations abruptly tighten during a downturn, what is the most likely outcome for a portfolio concentrated in 5 banks? The choices are: largely unaffected due to diversification, could suffer a catastrophic drawdown, dividends will automatically increase, and currency risk disappears. You may pause the video now to consider your answer. We will discuss the answer in the next section. The correct answer is that it could suffer a catastrophic drawdown. Tightened banking regulations and a downturn can pressure earnings and dividends across the sector simultaneously, and a concentrated portfolio magnifies this effect. To reinforce learning, here is a brief cheat sheet. First, spread risk across sectors, countries, and currencies. Second, prioritize total return rather than focusing solely on dividends. Third, keep any sector tilt small to avoid dependence on one industry. Fourth, rebalance consistently to maintain your target allocation. Fifth, accept normal market volatility while avoiding catastrophic sector-specific risk through diversification. Here are the key takeaways. Global ETFs reduce unsystematic risk through broad diversification. Concentration in bank stocks ties your portfolio to one sector's regulations and credit cycles. Dividends are useful but not guaranteed, especially in crises. True safety comes from spreading risk broadly. Finally, maintain a disciplined plan that automates contributions, rebalances periodically, and limits sector bets to small portions of the portfolio. To conclude, diversification remains the cornerstone of resilient, low-cost investing. Concentrating in a single sector invites avoidable catastrophic risks. Choose breadth over familiarity, and allow a global ETF to carry most of the workload. Implement your plan and remain disciplined across market cycles. Finally, thank you for watching. If this video helped, please like, share, and subscribe for more evidence-based investing content. Share your thoughts and questions in the comments so we can learn together.